Greetings viewers, I, Dr. Isha Raval, IQAC Coordinator and Associate Professor at Vivekananda Institute of Professional Studies, Technical Campus, welcome you to the series on Security Analysis and Investment Management. In today's session, we will be learning about what exactly is systematic risk or market risk. And we will also try to understand that what are the procedures, what are the methods with which we can calculate the systematic risk associated with a security. So primarily there are two objectives which we will be covering here in this session. One is the concept of market risk or systematic risk, and how do we calculate this systematic risk which is associated with one single security. So when we talk about any security and when we try to invest, there's always at the back of our mind that there exists some risk. There is going to be certain quantum of risk. Now, that risk which we say is actually the total risk associated with any stock, any security or any financial asset. Now, this entire risk is actually a sum of the systematic risk in one hand and unsystematic risk on the other. What exactly is unsystematic risk? Unsystematic risk is the extent of variability in the security's return due to the specific risk attached to the firm of that particular security. For example, if you're talking about a stock like say Reliance Power. Now Reliance Power belongs to the power industry, and if we put all our funds in just one sector or in just one stock, we are in fact just investing in one stock would be much riskier than investing in multiple securities or in multiple assets. So any bad news which affects the power sector certainly will have impact on Reliance Power as well. So any risk which is associated to a single security which is belonging to that specific industry, maybe to a specific sector, because of maybe some government norms, there are some bad news. So whenever the impact is there, that negative impact certainly affects us whenever we put our funds there. So any risk which is associated with a single security due to these specific risks particularly attached to that particular firm or that particular security is known as unsystematic risk. It is actually a diversifiable risk, and hence this risk can be removed from the total risk of portfolio. How can we do that? By investing in large portfolio securities. That means we should avoid putting all the eggs in one basket. Rather, whenever we plan to invest any certain amount of funds, we need to diversify, we need to select different sectors, because if we are investing in just one security, like the example which I just cited about Reliance Power, we are investing in a riskier asset because we are prone to greater quantum of risk as we are not diversifying. So how do we diversify? This is possible because the firm specific risk factors, they are mostly random. For example, if the financial position in one company is weak, the financial health of the other company in the portfolio can certainly be strong enough to neutralize the risk attributed by the weak financial position of one specific firm in which we are investing. So if we select Reliance Power at one hand, we may select the one stock from the banking sector. We may select one stock from the FMCG sector. So we are kind of creating a diversified portfolio wherein if there is a loss in the power sector or if there's some negative news in the power sector which impacts the stock price of Reliance Power, we have the gains, we can neutralize the loss with the gains made from the banking sector or maybe from the FMCG sector. So this is how we can actually diversify the unsystematic risk by investing in different sectors, by investing in stocks belonging to different industries. That is why the unsystematic risk is also known as diversifiable risk. Now the other part of total risk is the market risk or systematic risk. Market risk is that part of a security's standalone risk that cannot be eliminated by diversification. Why? Because it depends on the factors affecting the whole market in a particular direction. So, as the name suggests, systematic risk, a certain type of risk which is applicable to all the stocks, which is applicable to all the securities, which is applicable to all the financial assets in the market, in the system. So systematic risk is kind of a risk which cannot be avoided. It cannot be diversified. Even if we put our money into 5 different sectors, into 5 different stocks belonging to different industries, there still exists certain amount of risk, and this risk is known as systematic risk. Let us try to understand it with the help of an example. Say, for example, there is a steep rise in inflation in India. Now, this rise in inflation will affect the entire market adversely, and therefore, no diversification can make a portfolio free from this risk. For example, if you are investing in 5 different sectors, maybe 5 different stocks, and the government announces a rise in the repo rate, or if we identify the numbers come of the inflation, we understand that the raw material for all the sectors will get expensive. Why? Because there is a rise in the inflation rate. And this inflation rate is applicable to all the stocks, all the industries in the entire system in the market. That is why systematic risk, which is also known as market risk, can certainly be called non-diversifiable risk. Okay. So, how is this market risk measured for individual securities? Now, the term which is used is which is known as beta coefficient. This beta coefficient describes how the expected return of a stock or the expected return of a portfolio is correlated to the return of the financial market as a whole. That means we are trying to understand what is the correlation between stock A and the Sensex, because when we talk about Sensex, it represents the market. When we talk about Nifty, which is an index of 50 stocks, top performing 50 stocks. Now, how we try to analyze that, suppose we pick up a stock A and we pick up the prices or the movement which is happening in Sensex. So, how are these two correlated with each other? Are they moving in tandem with each other, or are they inversely correlated? So, is it whether there is positive correlation or whether there is negative correlation will actually determine the quantum of loss or the quantum of profit which we can make. So, beta coefficient actually describes how the expected return of a stock is moving vis-a-vis the return on the market, on the financial market. And when we talk about financial market, we actually pick up index which represents the market as a whole. As you know that in Sensex or in Nifty, we have representation from all the industries. Majority of the top performing stocks belonging to different sectors are collated, and the top performing 30 stocks are included in Sensex and 50 stocks in Nifty. So when we compare our investment, that how this investment is moving, suppose if the market falls, so how is our stock moving? Is it rising or is it falling? So this sort of correlation study needs to be done, and when we do this study, we are trying to identify what is the beta coefficient. Now, how do we measure it? It is measured by a stock's beta coefficient, which is calculated as the covariance between security, say A, and the market portfolio in the numerator, and we divide this by the variance of the security in which we are investing. So, I repeat, the beta coefficient can be calculated as the covariance between the stock which we are investing and the market portfolio. This comes as the numerator, and in the denominator, we divide this with variance of the particular security in which we are trying to invest. Now, the stock beta, in addition to measuring your stock's contribution of risk to a portfolio, the beta measure, it actually calculates the stock's volatility relative to the market. That how volatile is the stock? Is it that it is moving up and down frequently, or is it kind of stable? Is there any sort of consolidation which is happening with respect to this particular stock? So, what is the pattern which the stock is following when it is whether it is rising or whether it is falling in comparison to the market? So, we are kind of through beta calculating that how volatile this stock is. So, if the beta value comes out to be really huge, maybe say 2 or 3, then we say that this stock is very, very aggressive. This stock is very, very risky. Now, beta is actually, you can say that it can be referred to as financial elasticity. That how elastic, what is the sort of financial elasticity with respect to a particular stock, or what is the correlated relative volatility of a particular stock? Because we are trying to identify how volatile, what is the sort of movement. Is it so very, very frequent? It is huge, or whether it is small in number. So, beta is a measure of the sensitivity of the assets returns to the market returns, and hence it is known as non-diversifiable risk, or we can call it systematic risk or market risk. So as the name itself is suggesting that we cannot diversify, that means we put our funds in any of the stocks, we still have in our portfolio the basic systematic risk. The inflation example which I just cited is the best example. Inflation rises applicable to all the stocks, whether you have 5 stocks or 10 stocks or 20 stocks in your portfolio. If there is a rise in the inflation, it is certainly going to impact your portfolio return. Now, let us try to understand and interpret beta a little more. So what is the way, suppose the value of beta when you calculate by calculating the covariance between stock A and the market and divided by the variance of stock A, if we calculate it and the value comes out to be 1. Now when the value is 1, we are actually investing in one stock which is representing the market risk. That means this stock is neither more riskier or less riskier than the market. It has average risk. That means it has the risk which is just equivalent to the market. So if there is a rise in Sensex, the stock rises. If there is a fall in Sensex, the stock in which we have invested also falls in the same quantum. For example, if the stock, say for example, if Sensex falls by 10%, then the stock with a beta of value 1 will also fall by 10%. But what if when you calculate the beta, you realize that the beta of your stock is greater than 1? Now, when you have a stock with, in your portfolio with a beta greater than 1, that means the stock is very, very risky. That means it is riskier at least than the average. Now, it depends on the number, whether it is 1.5 or whether it is 1.8 or 2. So, the higher the beta, the riskier the stock. Why? Because with a fall in the market, there is going to be double the fall in the stock in which you have invested. But if you are, say for example, a risk-averse investor, you do not like taking risk, you prefer avoiding risk, you want to play safe, you invest in blue chip companies, and you do not want to create a portfolio which has a very, very high volatility rate. So you as an investor should prefer investing in stocks with a beta less than 1. Because even if the market, for example, falls by 10% and this beta of the stock is 0.5, so the fall in your portfolio will just be 50% of the fall of the market. So if it is 10% fall in Sensex, it is going to be 5% for you as an investor. Now, what is the average betas? If we actually see, most of the stocks, they have betas within the range from 0.5 to 1.5. So any stock greater than 1.5 will be extremely risky. Less than 0.5 is actually not possible because there is certain quantum of risk which is always existing. So this risk, which is non-diversifiable, is actually the systematic risk and is represented through beta. Now, how do we interpret it? As I just said, that an asset with a beta value 0, it means that its price is not at all correlated with the market. That means whether the market rises or the market falls, this stock is independent, which is usually not the case because every stock gets affected through systematic risk. But yes, if the value comes out to be 0, we can certainly say that the stock is independent and is, not correlated to the market. A positive beta means, so when we say positive beta, anything above 0. A positive beta means that the asset generally follows the market, and if there is negative beta, which is minus, it shows that the asset inversely follows the market. That means there is negative correlation between the stock in which you are investing and the market, and this certainly means that the asset generally decreases in value if the market goes up. Why? Because of the negative correlation, because the stock is not following the market as it has negative beta. This was about general calculation of stock beta. Now we have the concept of geared beta and ungeared beta. Geared means levered. That means a firm which has debt in its capital structure, which is using bank loans or maybe has issued debentures or it has taken a term loan. So a firm which has bank loans or is geared or is levered. So the beta attached to the ordinary shares of such a firm, they are known, the beta is known as geared beta. It is known as geared beta, and why? Because the firm is levered. That means the firm is using debt. That is why the beta of this stock is known as geared beta, and it has a much higher risk than the firm's basic activity. That means if there is an investor who is investing in a company with a capital structure where they have equity shares, they have debentures, they have bank loans. So the investor is investing in a firm which is levered, which is making use of the debt. And when the person is investing in such a firm, the beta calculated will be known as geared beta. Because of the presence of debt, this firm will be considered to be riskier than the market. But if you invest in a firm which does not have debt, which does not issue debentures, has just its own funds, just uses equity shares, so an asset beta is sometimes called ungeared or unlevered beta and can be described as the beta of equity in a company that is totally equity financed. That means in the capital structure, if there is just capital, just equity shares and there is no debt, there is no debentures, in that case you are investing in a company which is pretty safe, because you are putting your funds in a company which is unlevered, which is ungeared, and that is why the beta of that company would be relatively less. It would be less riskier, and the name which we will give to this sort of a company will be ungeared beta. So geared beta, levered company; ungeared beta, unlevered company without debt. Now, up till now, we have understood that what exactly is total risk, which is a summation of unsystematic risk and systematic risk. Then we have done the calculation for a particular stock or an equity. What is the formula to calculate? We use beta for a particular security, and what is the formula? We calculate it by the covariance between the security and the market, all of this divided by the variance of that particular security. We also understood that when a firm uses debt, it is known as levered beta. When the firm does not use debt, it is unlevered beta. But as an investor, we never invest in just one stock. So we understood that yes, how do we make the calculation of beta of a particular stock? But what if I have invested in, say, 6 different stocks, and all these 6 different stocks, they have different betas? How I as an investor can calculate that what is the beta of the overall portfolio? So what is my portfolio beta? The beta of a portfolio, it is the weighted sum of the individual asset betas. That means we are going to calculate the individual betas of all the stocks in which we are investing, and then we need to do the calculation of weighted summation of all of these betas. According to the proportions of the investments in the portfolio, for example, if there is a company, say stock A, and then there is another company which is stock B, and we put 50% of our money in stock A and 50% in stock B. Stock A has a beta which is as high as 2, while stock B has beta which is equivalent to 1. So any company which has a beta equivalent to is actually representing the market. So in our portfolio, with 50% in stock A, very aggressive company, beta equaling 2, and the remaining 50% we have invested in stock B, which has beta of 1, which is actually representing the market. Now, how do we calculate the actual beta of the entire portfolio with 2 stocks? So we are going to calculate 50% into 2 plus 50% into 1. So when we do the weighted sum of the individual asset betas, we come down to a value which is known as 1.50. Because when you will multiply 0.5 into 2 plus 0.5 into 1, the actual calculation comes out to be 1.5. Now with this example, we can clearly understand that if we have 2 stocks, what is the role of diversification here? We have invested in 2 stocks. The beta of the first one is 2. That means this stock is extremely aggressive, highly risky. So if the market falls by 10%, the fall in this stock A will be 20%. If market falls by 20, it falls by 40%. So we are kind of investing in a stock which is very, very risky. Whereas the second stock picked by us has beta which is equivalent to 1. That means this particular stock is representing the market. Market rises by 10%, this stock rises by 10%, market rises by 20, it rises by 20. So when we try to see that we have two different stocks, 2 and 1. Now when we do the calculation of this, now here in this case, when we do the calculation, we do the weighted sum, 50 into 2 plus 50 into 1, and we come down to a value which is 1.5. So therefore, by investing in stock B, which has a lower beta than stock A, we have kind of brought down the overall beta value to 1.5. And here comes the role of diversification. That is why we must have stocks which have maybe very, very high beta and then very, very low beta as well. That is the role of diversification here. Let us calculate one more. Say for example, as an investor, you have a total of 1 lakh rupees and you've selected through maybe fundamental analysis, through your technical analysis, you kind of selected 6 different stocks which are stock A, stock B, stock C, D, E and F. Now all these 6 stocks you have identified, and as per your calculations, as per your comfort level, you plan to invest 25,000 in stock A, 22,000 in stock B, 20,000 in stock C, 18,000 in stock D, 9,000 in stock E and 6,000 in stock F. So this is the kind of distribution of funds which you have done with the 1 lakh rupees you have. Now if we do the calculation of this 1 lakh, how have we divided? We need to calculate the share of each stock in the portfolio. Or in other words, we can say what is the weightage of stock A in the portfolio, what is the weightage of stock B, and so on and so forth. For doing this calculation, we will say for stock A, my W, my weight will be 25,000 divided by 1 lakh, which comes out to be the value of 0.25. The second stock, 22,000 divided by 1 lakh, so the weightage comes out to be 0.22. For stock C, it is 0.20. For stock D, it comes out to be 0.18. For stock E, it comes out to be, similarly, when we do the calculation, we calculate all the shares and ultimately we get 1 in the answer. When we do a summation of this, just to cross check that whether we have calculated all the weights properly, we must divide the value by the total investment, the value in stock B by the total investment, and calculate the weights. The total of all the weights should be actually 1. Then we have beta. The beta represented by stock A is 1.43, for B it is 0.63 and so on and so forth. So when we do the calculation, we try to find out the weighted beta. And how is the weighted beta calculated? Weighted beta is calculated by multiplying the weight of stock A with the beta of stock A and so on and so forth. So when we do the calculation, our actual value, the net portfolio beta comes out to be 1.0171. That means we have stocks which have very, very high beta, starting maybe 1.51, like 1.22, 1.43, and we also have stocks in the portfolio which are less than 1. So when we create this portfolio, our entire portfolio beta comes out to be 1.01, which is nothing but actually representing the market. So this is how we calculate the portfolio beta. Thank you so much. Keep learning.